Welcome back, everybody, to Back to Basics, SMC or ICT. I decided to call it Back to Basics because I've already explained most of these things, but now they're explained, I guess, better than the first time I did it. Because when the first time I did it, I had only been studying ICT for a year, and now it's been almost 2 years. I mean, I first started teaching this when I was 8 months in, something like that. I'm gonna say 8 months, but it's been more than a year now since I posted my first video. But in the last video, we covered the get starteds, facts and Qs, or facts, and we went over candles and liquidity. So now we're going to go over the market structure shift or displacement. So let's open this up real quick. I do have images on, or photos on this. This is quite short and sweet, so I guess we can take some more stuff. I'll just see how long I can go today. But market structure shift, displacement. Now, what is displacement? Displacement is an aggressive move with full body candles. This can be a singular candle or also multiple candles. And the easiest way to spot it is just looking for fair value gaps. Now, if we look at this image, you see we have the high of the displacement to the low of the displacement. You see the displacement itself created a fair value gap with a market structure shift. We'll go over that soon enough. But you can see we created a fair value gap here. I know I haven't taught that yet. That also comes soon. But this is a SIBI, sell side imbalance, buy side inefficiency. But you can see this displacement right here is 181 ticks. That's a lot, especially for a displacement. When I see a displacement, I want to see around 80 to 120 ticks. So 180 is more than enough. This is NASDAQ NQ, by the way. I don't trade ES or S&P 500. This is NASDAQ. So this is the high. This is the low. The high and the low itself is 181 ticks, creating a fair value gap with it. So this right here is a valid displacement with the breaker structure. So what is a market structure shift? Market structure shift is what indicates a change in trend from bullish to bearish or bearish to bullish. How do we identify this? We look for displacement below a previous low, or if it's bullish, above a previous high. I also prefer to have a stop rate. This is supposed to be rate, I guess corrected that. A stop rate prior to this, which also creates a breaker formation and creates a high resistance liquidity. So if we take a look at this image, we have the same exact photo that I just showed here, but this is a bit zoomed out. I don't know why I didn't mark this low right here, because this is the one that created the market structure shift. But I guess these are all also confirmations. But as you can see, we broke below this candle right here. This swing low, we broke below it, closed below here. Remember when I told you guys about the candles? Open, high, low, close, bearish candle. The close is below this wick right here, or this swing point. So this right here would be the market structure shift. Same with this right here. You can see this candle right here closed below the swing point. And this candle right here closed below this swing point, creating the market structure shift. You can see this entire thing is displacement. So which is liquidity taken and which is market structure shift? Figuring out which is which can be a challenge, especially on lower timeframes after and higher timeframe liquidity has been taken, since it needs to create the stop rate. We ideally would like to see a 5-minute or a 15-minute market structure shift, but 1 minute will often be fine. If we have the displacement, we have market structure shift. If we don't, liquidity is taken and stop rate is being created. It's simple as that. So what do I mean by this? You can see right here, if we take just the same photo, for example, you can see that this candle right here actually closed above this point right here. But this isn't a market structure shift. Why? Because there is no displacement. This is simply a stop rate being created. People are getting stopped out. We finally displaced to the downside, disrespecting a fair value gap, disrespecting a fair value gap, disrespecting this low, closing below it. So bullish has now, we stopped being bullish, now we're being bearish, right? That's what I mean by that. You can say, oh yeah, it's a market structure shift, let's go long right here. You'd immediately get stopped out, like straight away. It's like within the span of 15 minutes, you'd be stopped out. But that's the difference between displacement and market structure shift. So now we're going to go into the fair value gaps. All the types of fair value gaps and each and every one. You can see this is a lot of stuff to go over, but let's do this relatively quickly, but I'll explain everything in detail, so don't worry. I don't think, I was just thinking about this because, I mean, this series is going to be one take, but I don't think I need to show the a live example. I guess I can do that real quick. Let me just clear all my drawings. Right? Now, what's a good one? Right here, right? We do have a low right here. And I guess we'll use this one instead because it's lower. You can see that this candle right here actually closed below this one. Let me get rid of macros. This candle right here, it closed below this one. So most people would consider this a market structure shift, but it isn't. I mean, yes, we did respect this SIBI. We did do that, but this is just a stop rate being created, right? This entire thing is just a stop rate. So once we do finally break over, we break above this high. Now let's see how many ticks this is. So from the low all the way to the high, 127. What did I tell you? Between 80 and 120 is ideal. So let's draw this busy out. Let's put our buy limit. Let's put our stop loss below the stop rate. 67 ticks, targeting the high up here. And as so, a 1 to 3 hour, 3 to 1 hour, whatever. But yeah, so this right here isn't a market structure shift. This is just a stop rate being created. So in reality, this is actually sell side liquidity. Now back to the drawing board. Fair value gaps. What is a fair value gap? Fair value gap, FVG is the acronym, is an imbalance in the market. There are two types of fair value gaps. Busy, which is buy side imbalance, sell side inefficiency, which is a bullish fair value gap. SIBI is a sell side imbalance, buy side inefficiency, which is a bearish fair value gap. What's the difference between bullish and bearish? Bullish is up, bearish is down. I think most people know this. Fair value gaps are created using 3 candles with a gap in the middle. The reason it's called a fair value gap is because in order for price to be delivered efficiently, these imbalances must be rebalanced. Because of this, the price will seek to rebalance these busies or SIBIs before continuing to its target. What's a busy? For a busy, a bullish fair value gap, it is a gap between the first candle's high and the third candle's low. In a busy, sellers have not been offered a fair value. So here's the first candle, here's the second candle, here's the third candle, sorry. This is the low of the third candle and the high of the first. You can see there's no wicks here, just the second candle itself. So this right here would be a buy side imbalance, sell side inefficiency. So sell side inefficiency or sell side has been delivered. Now it's buy side imbalance. So we're going to go up and fill buy side. So we go up, create the fair value gap, we come back into it and continue higher. As you can see, it's the high and the low, creating the busy. What's a SIBI? For a SIBI, bearish fair value gap, it's the gap between the first candle's low and the third candle's high. In a SIBI, buyers have not been offered a fair value. So this is the vice versa of a bullish fair value gap. The first candle's low, the third candle's high. You can see there are no wicks here, just the second candle's body. Once we trade into it, we continue lower. Before we continue with the inverse, I'll just quickly show you guys like all how it works, right? So we have a SIBI. You can see we created, trade back into it, respecting the mean threshold of it. Now, what is the mean threshold? So if you go into your rectangle, go to style, right? Yeah, middle line here. Check this on. This is important. You can see that the candles close below the mean threshold or the consequent encouragement, whatever you want to call it. It closes below it. So once this candle closes, you can be quite confident in the market's going to continue lower. And as you can see, it does. I mean, it took a long time to rebalance the low, but you get my point, right? Same thing right here. Actually, no, that's an inverse. That's an inverse too. God damn it. I mean, price today has been terrible. We can pretty much look at today's price action, right? So this is a SIBI, and this is a SIBI, and this is a SIBI, and what's more? What is more? This right here, this tiny one. There you go. That's a SIBI. This one right here. Oh, this one right here is the SIBI. You can see every time we tap into these fair value gaps, we continue lower. But that's how trends get respected. They create an imbalance, come back to fill it before continuing lower, and vice versa for longs, right? Now let's continue. What is an inverse fair value gap? A bearish inverse fair value gap, an IFVG, is formed when the price closes below a busy inversing that busy. A bullish inverse fair value gap is formed when the price closes below a SIBI inversing that SIBI. We can use these inverses like we do with any other PD array as a support and resistance level or a point of entry for a trade. Inverse fair value gaps are one of the best PD arrays used, as they are not just another PD array, but they formed by violating another one. So if we look at this, you can see we have a busy right here, and this is a bullish candle, a buy side imbalance and sell side inefficiency. So when price comes back into it, we expect it to push higher, but in this case it doesn't. It closes below it, trading back into it, creating another fair value gap. But we trade back into it. We respected 1, 2, 3, 4, 5, 6, 7, 8, 9 times before continuing lower. That's how good inverse fair value gaps are. So yeah, we come down. We didn't respect it. We violated, disrespected. Now we start using it as a resistance, right? We keep bouncing off it before finally going lower. And I can actually show that right here, because that did happen right here. You can see with this, we closed below it. As you can see, this candle closed below the busy. We expect the price to go higher, but it doesn't. What we do instead is that we close below it, trade back into it, finally before like absolutely obliterating lower. Like the busy is up here. Yeah, so this is what, 611 points, 2,445 ticks. Jesus Christ. But I mean, inverse fair value gaps are not that effective, right? I'm just showing you guys that oftentimes when market starts to reverse, it'll inverse a busy or a SIBI and respect it on the way up or down. All right, so what is a volume imbalance? A volume imbalance, or a VIP, is where no bodies of the candles overlap, leaving only wicks. These are imbalances like fair value gaps, so you can use those as an entry or a draw on liquidity. You can see there are no bodies here. Price trades into it. I mean, it's quite a new photo. As you can see, the candles are still forming here, but price trades into it before continuing lower. Let's see if I can find a right here. We have a VIB right here. Price comes into the VIB. I mean, like, we could have come into this fair value gap down here, but we don't. We just trade back to the VIB before continuing higher. So you would place your entry as soon as we touch it, your stop below the candle that created the VIB, targeting whatever buy side there is. And that's a 6.68 RR, Jesus Christ. But yeah, that's how VIBs work. They work in both directions, right? So like this right here, it's the same thing, right? That's also a volume imbalance. It's just where candles where they lack bodies. There you can see them pretty much everywhere, but picking the right one is where the market data comes, where you have to collect market data. Let's close that. Now, what is a balanced price range, a BPR? balanced price range forms when an imbalance, such as a busy or a SIBI, gets immediately rebalanced and closed through with one candle. BPRs have a very strong point of resistance as they have no liquidity in them. That means that the price will generally not want to go through BPRs to get to its target. If the price pushes through a BPR with a lot of strength, it can indicate that the price will want to keep going in that direction. So if we take the exact same thing I just showed you with the inverse, but we just change it to a BPR because that's what it is, right? I'll just do this and change it to a BPR, like so. You can see we have a busy and a SIBI inside of each other, which means there is no liquidity up here. So price doesn't want to take this out. It doesn't. So once we see that happen, we can take our entry as soon as the BPR starts. You can see like the fair value gap actually starts down here, right? So the SIBI would actually be this entire thing. But our entry is of the BPR, which is this candle and this candle. So like if we would say the wick goes all the way up to here, like so, this would be the BPR. But in this case, it's all the way down to here. So we would have our entry or our limit order as soon as we touch the BPR. We would have our stop loss at the high itself, just at the exact same price, not below, not above, just at the price of the high. We would draw our standard deviation. This will come soon enough. And we will be targeting -2, which is this liquidity over here. And that will be a 1.4 risk to reward. Coolio. What is a liquidity void? Liquidity voids are mentioned quite often in ICT's 2022 mentorship, but he seems to swap between two theories. One is that a liquidity void is where no price has been, neither a wick nor a body of a candle. Or it's a huge displacement with little to no retracement, and the entire displacement is an imbalance. Both of these are valid imbalances, but not recommended to be used as an entry, as A, the gap in price is always tiny, and B, the displacement is quite huge, so using an optimal trade entry fib is much better. So, if we need to go on kind of a higher time frame to see like liquidity voids, right? Because they're so rare to see. To see a genuine liquidity void, it's like how far back do we need to actually go to find a singular liquidity void? Because, I mean, actually, there is one. I think there is one somewhere over. Oh no, that's actually a VIP. That's a VIP. They often happen with a new week. Let me see. Like, just see how hard. This is me genuinely trying to find a liquidity void. It's just so rare to see because it's either a volume imbalance or just a regular fucking fair value gap. How far back am I? I'm in 2022 now. Here it is. Here finally. This is June 13th, 2022. As you can see, there is nothing here. Nothing. And this is a liquidity void, right? Or liquidity void. There is no wicks nor bodies, and this is the liquidity void. Now, the second theory is that it's a huge displacement with little to no retracement. I think that rhymes actually. But as you can see, we would actually consider this entire drop, or actually this entire bull run right here, to be a liquidity void. Because there's no retracement here. We have 1, 2, 3 fair value gaps. And once we take like this VIB up here, we just start to crash through all of this. You see, we touched a busy, we went a little bit up before actually just dropping all the way down, right? And this is an entire liquidity void. So what I would actually expect for us to do is come all the way down to here, if not all the way down to here. Like go back into the 17K, right? That's what I would expect. Damn, I remember when I was trading like 15, 14K. But yeah, this is right here is an entire liquidity void. It's between these two theories. So how can we use these? We look to enter into our position as we retrace back into the imbalances. Remember, the more confluence, the better for entry. What is redelivered rebalance? RDRB is a solid entry for those looking to join the trend. This is to join the trend, FOMOing in. Look for them once the price has displaced way too much, but hasn't reached its target. This is key. RDRB is always below a SIBI or above a BISI. They are the ones that create the breakaway gap. A breakaway gap is an unfilled fair value gap that we never fill and simply go for liquidity. It consists of two candles. The first one has a huge wick and the second has a body overlapping the entire wick. We draw this out and expect it to continue after consolidating inside of it. These will never form in OTE and rarely in equilibrium. They are often quite close to the current price. So, I'll show you a live example of this too. But as you can see, we have a high and a low. We have an RDRB and a fair value gap up here. As you can see, we trade into the RDRB before dropping lower instead of coming back to the fair value gap. So this would actually be a breakaway gap. But if we would draw, I bet if we draw a fib tool from up here to down here, the 50% mark is somewhere over here. So we never actually reach premium. Now, what I mean by premium, I'll also explain that now. Or I don't know if I've actually explained premium and discount in this. I don't think I have, so I will explain that now while I'm explaining RDRB. Right, so let's go back to the 1 minute time frame, and let's turn. What the fuck? Alright, let's turn this off so we actually zoom in. Right. So this right here is an RDRB. All of this. Redelivered rebalance. You can see that this first candle is a wick and the second candle is just a body. And we have a fair value gap up here. This right here is also an RDRB. But we have a fair value gap up here that we never actually retraced into. So price comes into this, consolidates inside of it, as I just told you, and then drops back down. Now, what is equilibrium and what is premium and discount? So we have the Gann box and the fib tool to tell us that. Let's put that into OTE. Right, we have two different tools to use. So first, the Gann box. It will tell us the difference between premium and discount. So if we draw from this high to this low, you can see below the 0.5 line is discount. Above the 0.5 line is premium. We would look to sell inside of this square, and we would look to long inside of this. Right? So you don't want to sell below the 0. Like this right here is not for us. Like this, we rarely do this. We rarely sell below the 0.5 line. Why? Because it's idiotic. Our stops are way too big and our target is way too small. Like it's just like a 0.6 RR, right? It's terrible. So rather what we can do is hopefully price will retrace into premium where we can finally enter our stop loss or take our entry, put our stop loss, and then put our take profit. And like immediately we already at like, 1-to-1 RR. Like I don't know what the draw would be here, but like we're already have a much better risk to reward if we simply wait and hope for it to reach premium, to sell at least. Now, if it doesn't, then who cares? Let price go without you. I'll show you a bullish example too, right? So same thing right here. We would draw our from the low to the high. We have a fair value gap here, but this is above discount, right? This is in premium. So longing here, targeting buy side liquidity. This is 1 RR, pretty much 1-to-1 RR, which is terrible. But if you wait and hope price comes into discount, immediately it's 2.28 RR. Much better. Much better. That's the difference between premium and discount. Is that can't be everything. Liquidity void. Yeah, that's everything. Let's go back to this. So now you know the difference, right, between market structure shift and displacement. And you also know what a busy, a SIBI, an inverse, a VIP, an RDRB, BPR, and liquidity voids are, right? So read this again, find examples on your chart, comment if you have any questions or want me to go over something again, because I'll happily do it for you guys. But anyways, my name is AC. Take care. Peace.